Hey, what's up everybody? It's Monday, April 4th. I sent out the new edition of MMT Trader. If you want to get a copy, go to my website, pitbulleconomics.com. All right, we had a nice day up. Today was the first Monday in as far back as I can remember that we didn't have selling in equities. We had all the major indices were up, and that looks like it is snapping a recent pattern, so that may be a good thing. Listen, remember I said that eventually this is going to turn into a FOMO rally, F-O-M-O, which means fear of missing out. Right now it's not. There is still quite a bit of skepticism, and there was just today I read that the chief market strategist at Morgan Stanley, I think this guy's name is Mike Wilson or something like that, he said that this is a rally in a bear market, and this is the end of the bear market rally, and the market is going to start going down. And he named a number of, he gave a number of reasons why. Actually, he gave 4 reasons why. If I could remember them off the top of my head. I mean, number one, he said that, you know, now it's kind of like payback for the accelerated demand of last year, which was driven by fiscal stimulus. To that, I would say, yeah, we're already seeing a pretty significant slowdown in GDP growth. I mean, first quarter GDP growth is expected to be anywhere from 1.5 to, 2.5%, and that is way down from fourth quarter of 2021, and for that matter, for all of 2021, that is a much lower growth rate. So I would say that that's a known factor right now. The next thing he talked about, basically, there are 2 other things that are kind of similar. I mean, he talked about higher energy prices and inflation. And again, he states this kind of, just this kind of corny saying, inflation is a tax. I mean, not corny, but I mean, it's just kind of one of these lines that you hear all the time, inflation is a tax. But, as I've tried to explain many times, it's a tax on who? I mean, it's a tax on consumers, but it's not a tax on producers. And we've seen many examples now of, first of all, commodity producers, in the manufacturing sector. I mean, all along the line where producers have been able to raise prices and bolster their margins. So you can't just say inflation is a tax. I've tried to explain this so many times that inflation is a redistribution of income. I mean, to the degree, if we're talking about what is produced in the United States, it's just a redistribution of income. And so is deflation or disinflation. It's the same thing. It's a redistribution of income. In the case of deflation, it goes from producers to consumers. Consumers benefit because prices go down. So, I mean, he has that wrong. He has that understanding wrong. He just falls back on this kind of a cliche argument. Inflation is a tax. I mean, to me, that sounds like something Peter Schiff would say. For a guy who is one of the chief strategists at Morgan Stanley, I would expect to hear something a little bit more sophisticated, but that's what he comes up with. And so basically also we are seeing now, it's the same thing. I mean, we're seeing slower growth rates based on the subtraction that inflation is going to impact on GDP. I mean, we're seeing that. That's in the forecast right now. So it's not like something that is unexpected. I mean, we have seen a very significant downward revision in first quarter GDP, and you don't think the market notices that? Of course it notices that, and that's why, we're not shooting straight up like we were from midpoint 2020 through most of last year, when it was a full-on, massive, unprecedented fiscal stimulus, and where inflation was really very mild still. I mean, we're not in that kind of a paradigm where, the market's just going straight up. And I said this months ago, that we're going to be getting back to more or less what is a normal trading pattern for the market, where we're going to have pullbacks. It's going to climb the wall of worry. It's going to go up 2 steps and then come back down 1, and this level of pessimism and negativity is going to stay around. And this guy, he is an example of that, I think. So those were his. There was one other I can't remember right now, but basically, it's about he's talking about a demand slowdown. He's talking about inflation. He's talking about higher energy prices. And, I have said that because the United States is a net exporter of oil and petroleum, the impact of higher energy prices will not be as significant or as severe as what we saw, like, for example, back in the 1970s. If we're exporting, then we're going to get, that's going to add to final sales of gross domestic product a little bit, but it's better than having a double negative, that being from inflation and, a big, wide trade deficit due to energy. So you have to take that into account. But I mean, the market reflects all this, I think, anyway. The other thing that's out there, of course, is the interest rate situation and the Fed rate hikes. Let me say this. Right now, banks are sitting on 80 billion of unrealized losses on their securities position. This is an all-time record high. 80 billion of unrealized net losses on their securities position. That's largely fixed income, it's their treasury positions, MBS, stuff like that. That has happened even though all we've seen from the Fed so far is a 25 basis point rate hike last month. So we're at an all-time record net unrealized loss on banks' securities positions. Like I said, that's mostly fixed income, and all the Fed has done is raise rates by 25 basis points. Given that information, don't you think that the market has already priced in, 3.5% Fed funds rate, 3.25% Fed funds rate? At the very least, it priced in 2.5% Fed funds rate. I mean, come on. The Fed raised rates one time last month by a measly 25 basis points, and we have the largest open loss on banks' securities positions of all time. I mean, that should tell you something right there. If this rate hike cycle, and we don't know how far they're going to go with this, and again, to me, I find it fascinating because it's going to, we're going to test out my theory, which is, that the Fed has to pay interest on reserves, and it also has to hand over money to Congress every year, and it has to fund itself. And we know it made 111 billion last year on 9 trillion, okay? And now if it jacked up rates to 2.5% on 4 trillion in reserves, that's 100 billion. That wipes out its income, basically, all right? It has very little at that point to hand over to the Treasury and to have money to operate for itself. Now, again, as I've said already maybe a half a dozen times, the Fed could probably keep on, paying that interest because there's nothing that precludes it from running with a negative cash flow. But, when it says to Congress, hey, we don't have any money to give you, I don't know how they're going to feel about that. So I'm excited about this situation to see how it plays out. I mean, I hope they jack it up for 2 reasons. Number one, I think it's already priced into the market because, again, all they did was a measly 25 basis point hike, and that caused banks to lose $80 billion on their positions. And number two, when they jack it up, I want to see if they're going to have money to pay interest on reserve balances and to be able to hand over any money to Congress. And when they don't have money to hand over to Congress or to fund themselves to pay for their own operation, that's going to be a very interesting situation, and I want to see how Congress is going to react to that. Just saying. So I'm excited for what's going on. I think the market is definitely, you know, this is not a wild runaway bull market situation where you're having trillions upon trillions of new stimulus being injected into the market. However, fiscal is still good. Look, we had a $633 billion month in March. We still have a decent amount, from what I understand, of IRS tax refunds that are going to come out in April. So April's going to be the tough month because we got tax filings, and that's going to be a big drain on you know, available cash that can go into the market. You got to pay the taxes. You know, that sucks a lot of money out of the system, and then it takes a couple of months for the government spending to just, you know, put that money back into the system. But if we get through April without too much of a problem, then I think, you know, everything looks pretty good. By the way, we started off April 1st. You know, the first of every month is always a big expenditure month for the government because you have, you know, you have major payments like Medicare, Medicaid, military payments, veterans benefits, disability, all that stuff goes out on the first of the month. We had April 1st, which was Friday, we had a 115 billion single day. So no wonder why the market was up. I mean, we rallied towards the end of the close on Friday. We rallied today. I mean, you had 115 billion injection into the economy in one day. You know, that's pretty big. But that doesn't happen every day. March finished with 633 billion. You know, if we get into mid 500 billions, and again, April's going to be a little bit tough because we got tax filings mid-month, and that's going to suck a lot of cash out of the system. But then after that, it all starts to flow right back into the economy again as the government spends that out. I think I mentioned on Friday that the deficit is down something like I think it was 787 billion compared to last year. That is a net reduction in transfers of 787 billion to the non-government. It's not good, but I don't think it's enough to put us into recession. I mean, we're still talking about at the end of the fiscal year coming in at probably a 2.5, 2.4, 2.5 trillion deficit. That's, you know, that's still sizable. All right. So I'm not buying the doom and gloom, folks. I think you got to buy the dips. I think the market is going higher, and you got to be patient on this one. It's not going to be like what we saw mid 2020 until last year. And eventually it'll culminate in the FOMO rally. All these people who are talking about, you know, this is the rally, this is a bear market rally, and you got to sell it now. I think they're going to be singing a different tune as we progress through the rest of the year. Anyway, that's it today, folks. Hope you had a good weekend, and we're off to a new week. Take it easy. Bye.